Hi guys, thanks for tuning in to another episode of Nuggets News or our monthly commodities update. We welcome back Marin Katusa. How are you, Marin?
Excellent.
Thanks for coming back, and I'm really looking forward to diving into the different commodities, what's been going on. We want to do this as a monthly episode for you guys at home. There's been a lot happening in the uranium space this month, and you've been writing a lot about the dollar swap lines. So we might just start off and give people a brief overview because we have been speaking a lot on the channel about US dollars and the demand outside of America and all the debt that's denominated in US dollars. So do you want to maybe just give people the overview of your thesis about this swap line theory?
For sure. So US dollar swaps, it's set up by the US Fed, so the central bank, and it's with right now currently there's 15 central banks that have been approved and they've accepted the terms and conditions for these swap lines. So like the ECB, Bank of Japan, Korea, even Indonesia was the 15th one. Now, what happens here is the central banks borrow in US dollars, and then from there they distribute because it's basically easing the temporary strain of those US dollars. Now, it's touching 500 billion, so it's half a trillion already. And it's less than 2 months that this has been going on. Think about how much media attention the $2 trillion Congress approval stimulus package got, and yet no one's talking about 25% of that. And yet the Fed can go to $2-3 trillion. It's all set up by a loophole in the 1913 Federal Reserve Act. The swaps are set up. The first Fed chief to actually do the swaps was Ben Bernanke in 2008. So when a positive swap line nation, I call, is with the 15 that have accepted the terms and conditions. So if you're a country, let's really hone in on really someone who's been nasty to foreign miners, which has been Indonesia. Indonesia really increased their taxes and government take on Freeport's big copper gold project called Grasberg. Now, Indonesia has to follow the rules to those positive swap lines because as much as they get in revenue in US dollars from Grasberg, which is the biggest mine in Indonesia, which Freeport built, they're not going to risk those swap lines because it's literally magnitude order more. Like you look at Bank of Japan's already over 100 billion, the the ECB's at 150 billion on just drawing down every day. So they're not going to risk that swap line to nationalize. Now, negative swap line nations is everyone else that doesn't have a swap line. So those countries are now in this G2 world where you have the emerging market superpowers, China, Russia, trying to gain influence and resources. These negative swap line nations are going to increase their taxes, increase their royalties, increase their foreign ownership up until the point that they decide, are they going to accept the terms and conditions of the swap lines? Because it's not stopping at 15 countries. This is a new setup that the central banks and government are going to use. And I expect next year after the election, if Trump wins, why would he allow the Fed to do this off of an archaic 1913 approval by Congress when the Fed governor has the ability to lend out to the ECB? ECB can now convert that into euros and lend out to Airbus, which is the big French airplane producer, and that's in direct competition with Boeing. But it's using the reserve lifeline of the US swap line. So expect this to become a serious geopolitical issue. And you're seeing it already nationally. Governments are threatening to nationalize, and they're going to do it under ESG, environmental, social, and governance. Because whether you're an Australia mining company, an American, or Canadian, every mining company is using that. Well, we don't want the social license. Well, who issues a social license? That term is so wrong. But under the ESG banner is actually what these negative swap line nations are going to use. And I think a real key line was what the Argentinian environmental minister hinted and openly is discussing about there should be a national Argentinian mining company because the foreign companies aren't respecting the water and they're polluting the water. He's using that ESG banner, and that was a big telltale signal to me of what these other negative swap line nations are going to do. So all I'm trying to get people to think about is these risks that aren't priced into the market. And so many of these companies that people think are bulletproof, well, they're a well-diversified company. Well, 60 to 65% of their revenue is coming from negative swap line nations. And let's take the streamers. There's a streaming company that's trading at 3 times NAV that has over 50% of its royalties coming from a negative swap line nation that it doesn't pay any tax in. Well, if you're the leader of that negative swap line nation, you're going to change that because it's easy prey under the ESG banner. So I'm just trying to get people to think about like most analysts in the business when they do their NPV5s, the net present value 5% discounts, they do it the same as if you're in a solid mining company in Australia or Nevada, as if you're in the DRC or Zambia or Papua New Guinea.
Yeah.
That doesn't make sense to us. So why should these investors not start questioning, hey, wait a second, that risk isn't really, it's about pricing the risk properly. That's all I'm trying to do.
Yeah, I do want to go over that again because there's like a lot of people that are just beginning this, and there's a bit of lingo in there as well. So we've been talking a lot on the channel when people understand about the US debt and how the US have got all this power, and a lot of countries around the world aren't happy that they get all these privileges by getting to decide who gets to borrow this money, and these other central banks now need more dollars. So if I strike gold in Australia, let's say Donald Trump strikes gold in America, and maybe Marin's in Indonesia looking for gold, and we all strike the same deposit size, then you need money and capital, and Indonesia don't have that same financing system as we do. Now in Australia, maybe there's a lot of shareholders or investors that want to give you capital. In America, it's very easy for all these companies or the shale oil companies to get capital off the banks at the moment. And in Indonesia, there's all those risks. So what Marin's sort of saying is the government, it's one thing to start a mine there, but if they don't feel they're getting their fair share, they can either nationalize the mine, which we saw this month with Barrick, or they can say you need to pay more tax, we want a stream or more of a dividend now. So there's kind of this renegotiating going on for governments around the world, and a lot of governments are really struggling at the moment, going into recession and looking at these huge deficits and saying, well, where can we get money from and whose pocket can we pick?
Look at Mongolia as a great example of that, on one of the largest mining companies in the world. It's been a back and forth dance between Rio and the Mongolian government on Oyu Tolgoi. First time I went there was, I think, in 2006. And, you know, they have that big agreement. They do the big press with the president. Oh, the funding's a little bit short on the budget. We got to go renegotiate. We're increasing the tax on Oyu Tolgoi. We've seen this time and again. And for whatever reason, the analysts have been getting away with assessing the risk across the board the same. I'm just saying, no, it shouldn't be like that.
Yeah. So another maybe good example for people to understand here would be two different industries, two different commodities. Everyone's familiar with oil now, and how the Middle East, we have very low cost oil. So it's not a level playing field in terms of needing capital necessarily to get all that oil or extract it all. But I think it's so interesting where someone like Argentina or Venezuela are very resource rich, and that doesn't necessarily translate into wealth and riches and value. So do you want to maybe talk about, I know it's a huge topic, we could do an entire video on, but why some of those countries, and again, probably tying it back to this US dollar swap line idea, why having all these resources doesn't necessarily translate to wealth?
You picked two perfect countries. So Argentina has some of the best shale oil potential on the planet. In fact, the first big successful European shale company is called Quadrilla. I was the largest individual shareholder. And the reason why we called it Quadrilla is we originally wanted to go to Argentina because of the Vaca Muerta shale, which essentially means dead cow. It's based off of the way the shale looks, like the dead cow hide skin. So problem is infrastructure. The cost to bring it in and the way the government's tax is set up, it just doesn't work. And then you look at Venezuela, people are shocked when I say they have the world's largest resource of oil. It's bigger than the Canadian oil sands and Saudi Arabia. It's a very heavy oil, but you look at every company that's gone in there and they discover and they develop it, and the government does that clawback, that negative swap clawback. And Chavez, rather than investing back into the development of these fields, he funded the social programs to keep that political agenda moving forward. Well, that works up until it doesn't. And we saw that with Mexico in the Cantarell Basin, which was one of the top basins in the world. But again, the Mexican government, Pemex, when they had it 100% nationalized, people forget that it was American companies that went into at the turn of the century and really developed those oil fields, and then the nationalization happened. So this is a cyclicality that happens every 20, 30 years. It shifts, where you had Peru was some of the worst places to invest. And then by the late 90s, it became a very good pro-resource copper region, gold region to invest in. So with these swap lines, it's a good starting base to go, wait a second. Doesn't mean everywhere in Canada or is super easy to develop. Mining is a difficult period, and there's places. I'm Canadian, and I've been part of a team that built Canada's third largest producing copper mine when we started it in 2006. I retired because there's certain parts that I just don't want to be involved in with the current political regime. But it's still better than places that are negative swap lines that are being discounted at the same rate as Australia and Canada. So that's what I'm trying to explain to everyone.
Yeah, for sure. Did you want to dive into uranium? I know that's something you've been concentrating on recently. Very interesting dynamics in terms of the processing that Russia has and the yellow cake. I know America are maybe trying to get back into the game, and you think that Trump is going to look very favorably and maybe apply tariffs. Do you want to explain your thoughts on uranium?
For sure. So you look at what the former Soviet Union between Uzbekistan, Kazakhstan, and Russia, the Russian influenced regions where the Russian funding. On my webinar, the first time the CEO of Fletcher Newton from Uranium One, the big Russian uranium miner, the first interview he's ever done with the West was actually with me. And we really dug into it. And it comes down to this. Kazakhstan went from the early 2000s to essentially less than 1 million pounds using American innovation with ISR and foreign funding. That's the key tag here, Canadian, Australian, French money, Japanese and Chinese money, and the Russians. And they developed the Kazakh fields. But when you go to Astana, a lot of people are surprised that all of the resources, all the government is Russian Cyrillic. So if you think that the Russians, there's that old saying in the Soviet days that all roads lead to Moscow. Well, that's the same thing still today. So you look at Uranium One is the Russian production of uranium outside of Russia. Well, they produce over 10 million pounds, and it's the largest in Kazakhstan outside of Kazatomprom. So they're very linkly tight, but it's all processed through Russian facilities. So that's that. It's about 40% of the world's primary production is Kazakhstan. And there's zero drilling going on right now for the further ISR development. So there's kind of this COVID has accelerated, the lack of drilling these ISR wells, which you drill today, you pregnate it, and what you're drilling today, you produce in a year in the production zones. So there's no drilling happening. The question is how long will it stay shut down when there's no drilling happening? You see the numbers out of Moscow, they're getting a lot worse. It's like they're in serious flare-up right now. So it's been down for a month and a half. If it continues for another 2 to 3 months, they can't catch up that drilling. Now, the Kazakhs are very resourceful. Never underestimate the Soviets. Like I call it, they can Stalingrad the problem, just throw people and money at it. But it takes time for the deposit to, when you load the solution, to impregnate the uranium that you bring up through the ISR process. So that's the issue. Then you got the U.S. situation where Trump, I expect he's already put the groundwork in, where he's going to buy 150 million pounds, dollars worth a year in U.S. produced uranium. But he's not going to prop up welfare companies, nor is he going to fast track permitting. There's this misconception in the market saying, oh, well, they're going to buy American, so they're going to permit my project a lot faster. No, permitting a uranium mine in the West is one of the hardest commodities to permit. And all I'm telling people is be careful of what you're investing in. You don't need to go to AK-47 nations where, these projects, I remember 20 years ago when I started in this, the same projects are under a new management team. They may call it differently, and they're saying, we're going to produce. Well, if it didn't work at $120 uranium, why is it going to work at $40 or $50 uranium? It's not. So I have zero exposure to that. I think the simplest way to play is the U.S. permitted, built, ready to produce, and that can be economic at 45, between $40 and $50. That's where I see the government quota set, probably 50, 55 on the high end. And that means the conventional production. So that's when you actually go and dig up the rock. And so what people think of mining, where you crush the rock and extract the uranium from the ore, that's not going to be economic at 45, 50. You still need higher prices. So I get a lot of hate from the uranium world, but sorry, I've been there. I'm still one of the largest financiers in the game. I've been there and done it. You just buy these producing, built, permitted assets that are a discount to NAV. Keep it simple. Why take risk?
Yeah, so it sounds like it's a very different kettle of fish to the oil, where the other competing
Totally
nations
different.
that Americans
Yeah.
trying to capture market share off, they can't compete on price, whereas they can a bit more here, and they've got the capital behind them to do it. Um,
The one positive that came out was I've been very conservative on it because, where's the growth going to be? Well, the Russian strategy is not just produce and develop, but they actually fund and build the nuclear reactors. So the West are going to have a hard time with that because of the costs of building these for, when you look at the GE plants or what the Brookfield group just bought, the infrastructure plan of that from Westinghouse. Um, my theory is the Americans are 25% of the world's consumption, and the government released a report today actually that said, "Hey, 40 years is what these plants were designed for, but with some certain modifications, we will um, permit an additional 40 years." And I said it would be around 20 years, so I was being conservative. But if the government of the U.S. start amending the permits that these existing producing plants can go to another 40 years, that's very bullish for the thesis that I have as stick to developing producing uranium assets, because the government will want to look at 10 years of reserve life index that you can be producing at, say, $55. That's kind of the sweet spot that the government will, because what Trump will try to do, that the green energy revolution under Obama, he doesn't want hundreds of billions of dollars going into money heaven, which happened in the green revolution because the projects just didn't work. So they've learned from that, and the Republicans are going to focus heavily on de-risking their government exposure to this. So that's kind of my take on it.
Yes, nobody wants to waste money at the moment. It's already governments are starting to talk about who's going to pick up the bill for all this spending. In terms of the oil and gas space, we've seen oil, I guess, float a lot higher than people would have expected after we saw it turn negative. Now we are coming closer to that expiry again. What are your thoughts on oil? Because I'm reading that the amount at sea is still at these record levels, and why is oil hovering this high?
I think a couple of things. It's still under 25 in the US, and that's the WTI price. The actual price at the wellheads are a lot lower for most of the producers. So that's one thing we got to break down the regional areas. Brent oils, last I looked, was like 28, and that's just the tag price. Again, the producers in different regions get different prices depending on where you are in the logistics of the pipeline. But a lot of people are expecting, the market is expecting, that as we enter June, that things are going to open up. A lot of people didn't expect what the county of LA said, hey, we should probably stick around for 3 more months. The question is the economy going to open up and more transportation? Will the airlines? So there's a lot of speculation built into it. There's no shortage of supply. And one thing I got to emphasize to everyone is a lot of media journalists were writing how the companies are going to go bankrupt and all this production will come offline. People need to understand that even if a company goes into bankruptcy, when you go into bankruptcy proceedings, the fields still produce. Now, obviously not as optimally as if you have the existing management team, but when the bankruptcy proceedings happen, production still continues. And it's not like a lot of these things are just going to shut down. So I just want people to understand that there's no shortage of the oil. And the thing that we talked about the gas related is, as they're drilling fewer gas wells, you're going to see that price. Remember, we were talking about where could there be some potential. There was so much gas in these wells that they were flaring them. They were getting rid of it. They didn't even bother putting it into the system because gas was worthless. So you got that angle now. So you get less production of new wells coming in, less rigs, but there's no shortage of oil. Nothing's going to change in the near term.
Yeah, I shot Marin a message saying, is natural gas a bit of a commodity here that people have taken their eye off the ball? Is there a possible short play here? And they're flaring the excess supply, but the price doesn't seem to be representing that. And is there any reason for that other than what you've just touched on then? I mean, to me, if they're flaring this gas,
like LNG is one that I think has been, nobody's talking about how much negative impact there's been on the pricing. So Qatar and Russia are some major producers of LNG. Then the Americans started producing it and shipping it to Europe, and the price of LNG has gone down. Again, that's when no one's talking about that could see more downside, meaning lower prices because of storage capacity. So if the economy doesn't quite come back the way the market is speculating, I think LNG has more pressure, and the massive capexes that have gone into that and the debt on those balance sheets. So there's a lot of the wall of worry is still very well alive, both in the oil and the gas complex. So don't try to catch a falling knife. It's still too early, in my opinion.
So if that was to play out for the beginners at home, is the ETF UNG an okay way to short, or the natural gas futures, or are you looking for more advanced guys to be targeting the actual companies to short?
Yeah, so I'm always, because I don't believe retail people should get involved in shorting unless you're really focused on a day. Like if you're running a business, being a shorter is very difficult. So I it's something I don't do, nor do we get involved in it much. And again, ETFs are never a good long-term bet. So if you're playing that angle, make sure you have a short-term horizon. And people saw when it went negative, what can happen to you playing these, because the repercussions can be much worse than what you expect. So I don't recommend that strategy. I'm more of an alligator. I like to buy discounted assets that are pretty bulletproof balance sheets at a significant discount. We just recommended one recently. It hasn't hit our target price, but it will if you're patient, and it'll pay me a 10-12% coupon. And I did that on Pembina and Brookfield, and we had big scores that pay big yield. You just got to be patient, and you don't want to have these unforeseen risks that people saw in these ETFs when it goes negative.
Yeah, I haven't looked at the specs. Do you know the specs of the UNG? Is it the same as USO, where it just rolls them?
Exactly, and they're trying to change it, but by the time it changes, the investors get screwed. So they're trying to change it, but it's the same setup.
Yeah, don't hold those ETFs long term. Okay, so other soft commodities, we're waiting to see now if the economy is going to reopen up, if that copper demand's going to come back up. I think we have seen a lot of these commodities indexes break down from key levels. Technically, I'm a believer that things aren't going to go back to normal. This is going to be a very, very slow process, and we're going to see some second waves. So what is your thoughts on copper and these other commodities? Is the economy and GDP going to be lower for longer?
Copper is a really interesting one, because if you look at the global production, almost half of the world's copper production comes from Chile and Peru, both negative swap line nations. And generally speaking, pretty pro-mining, good jurisdictions to be in, relatively speaking, to some of the African countries where a lot of the copper comes from. So I just think that the debts on these balance sheets of the copper producers, they're staying alive not because of the ingenuity and the production optimization of the management teams. It's essentially because of the strength of the US dollar relative to their local currency, because their costs once they're built. And I'm very bullish longer term, but I think there's more downside pressure in the near term in copper. And copper assets are so difficult to put into production, like the big porphyries, the big open pit. You can't build a mid-tier, so like a small 100 million pound copper porphyry project. That's like a mid-tier mine. That's $1 billion. Okay, I don't care if it's in Canada, the US, or Chile, or Peru. Flat out, it's $1 billion. So some of the bigger boys that really move the needle for the big producers, you're looking at $4, $5, $6 billion capex. I don't see them rushing to build those now. So you're not going to have an oversupply of copper to the way we've seen in oil. But at the same time, I agree with you, Alex, that we're not going to see this incredible recovery. And I just don't see the car revolution, the electric car revolution, increasing at the rates that everyone was expecting. Because are people going to be rushing out to buy electric vehicles? I think they'll stick with what they have for a little bit longer. Plus, the last 2 months, people were essentially going nowhere. And I think there is a new normal going to happen. So I just think people aren't going to be rushing to upgrade their vehicles. And I think there's more downside pressure in the copper market. It's going to be a great place to be when it washes out, but I think there's more downside potential over the next 6 to 12 months.
Yeah, I was going to ask, what percent of copper are people sort of pricing in the demand for these electric vehicles? Like, what percent of the
Well,
market is that?
yeah, so I've got a great chart that I published for that BHP, Rio Tinto, Glencore, and then Robert Friedland, who I got to know in 2007, who's probably the world's greatest promoter. So he's very bullish on copper. He had the highest, and then I had the lowest one. And you look at by 2040, something like 30% was expected to go into these electric vehicles. And,
Yeah.
I know it sounds like a far off number, but, the thing that nobody's actually talking about is, if we get to the point of smart cars, you're not going to need the number of cars, because it'll be more optimized, meaning one car may have a higher utility between you and your wife or your family, and it'll be able to drive itself. So those numbers were something that weren't incorporated in everyone's model. And I only included a little bit. And when you start seeing, if you can increase the utilization rate of one car, say I drive to work, I park my car under my building, and it does nothing until I go home and I drive back. But what if it could be a cab, and then gas stations become service cleaning stations? So when it comes to pick me up, it's clean and as no one's been in it. I think it's going to change in the future, where a lot of expectation is built for the copper market to go into these electric vehicles, but I don't know if we're calculating the utilization rate properly, and that's something to be seen. So I'm pretty, I'm cautious right now. I think there's more downside. I've been involved in teams that build copper mines, so when I go to site visits, you kind of figure it out after 15 years what it's going to take, the actual costs. It's difficult to build these mines, so they're there and they're valuable, but we've seen some incredible asset pricing here in March, and I think we're going to have another test of those lows. So if you got cash, stay on the sidelines and be patient.
Yeah, we hear things like technology is deflationary, as in technology brings down prices of things. And you can think about like the Airbnb model, where people renting out their home. If you have a car, it might be able to drive around with AI technology all day and make you money on the sidelines, and that's going to bring down the cost of transport. Oil's very cheap, petrol's very cheap at the Bowser now. So people that have lost their jobs, are they going to go out and buy a Tesla compared to buying a 10-year-old secondhand car and just running it on really cheap oil? So that's kind of what we're looking at in the short term, until maybe those longer term themes play out.
I'm with you.
Next thing, just quickly, gold and silver. I know you haven't been too bullish on those necessarily short term. Very interesting. Australia had record sales or exports of gold to hold up our economy, which was fantastic. Any thoughts there? Silver's played catch up a little bit, but I do think it is, I guess, maybe losing its monetary premium a little bit at the moment.
Well, silver's kind of one foot in the precious metal camp, and 1 foot in the industrial camp. And because everything in the slowing global economy kind of essentially came to a halt, that industrial demand just came to nothing, and then you have that monetary aspect. For myself and my portfolio, we've been much more exposed to gold. It's been an incredible place to be. We've taken a lot of profits on the gold side of things. I have my core positions that I haven't touched, but I want to see gold. I'm not convinced it's going to break out yet, and it's what I've been writing about for a few months. It's sure given up a good fight, and it's holding strong, and you can see when there's a lot of selling pressure coming, it dips down just under 17 and it comes out. I'd like it to see it break out here. I don't know if it does or not. I don't try to project those types of things, but $1,700 is a fantastic price for the producers. If you can't make money at 1,700, you shouldn't be in the production game. So you look at Australian prices, Canadian prices, it's all-time highs, and that's going to continue. I think whether it pulls back a little bit, I think there's a lot of money on the sidelines waiting to get into the gold space. So of all the commodities, gold's the place to be right now, in my opinion.
Yeah, the Aussie gold producers are very happy selling at $2,900 an ounce Australian. Yeah. I think that's most of the things I wanted to touch on today. Anything that you wanted to talk about, just wrapping it all together? Actually, no, there is something I wanted to talk about. So just recently we've seen in the ag space, China come out and say, well, we're banning 4 abattoirs of Australian beef. We're going to threaten to do 80% tariffs on barley. All of a sudden, that is one of the tightest and biggest relationships in world trade. if that relationship can break down, what does it say for the, I guess, commodity space and the relations between different countries as we head into this trade war?
This is what I'm getting at. I think people have become too complacent on the way it was. You look at China's refusing to allow the experts, the international scientists, to get in to see what's going on with the virus. Like, you don't refuse someone to come in unless you're hiding something. Like, what is it? I don't know. I'm not a conspiracy guy, but things are changing here significantly. You look at, what has happened between Russia and Saudi. They were very friendly, and then they had that big spat. When there's a shortage of dollars and you're missing US dollars and you're missing your budgets and you're dipping into the piggy bank and you start getting social unrest, alliances are going to be tested. And this is where I go back to, what are the positive swap line nations and negative swap line nations? And things are going to happen that we didn't expect. And I think right now the biggest risk to everyone's resource portfolio is the political or the geopolitical risk that people have taken for granted because everyone's become so complacent. Because during the last major financial crisis of 2008-09, we got through it. It worked. But this one's very different. You had three big impacts all hit at once. And with what's going on globally, the second wave coming in the fall, will there be a vaccine? There's so many unknowns right now. And I'm just saying, this risk to reward, people need to be very cautious where their portfolio is at, because it could turn very quickly.
Yeah, I can't wait to see the role that possibly digital currencies play in this, because we've got so many digital US dollar currencies now. And if the world is really craving these US dollars, are people going to try and get there through the route of the digital way that is available these days? And crazy, during the month we saw Iran come out and just say we're going to knock 4 zeros off our currency, and they're starting to go down that inflationary route.
Well, did you see how Iran did the gasoline upgrades for Venezuela? And I don't know if you saw how they got paid, but they got paid through the bullion from the Venezuelan vaults, and they literally flied it back into Tehran. So you look at, whoever thought that you'd see Iran coming to save Venezuela's gas infrastructure and the upgrade facilities, and then have their private planes load up the gold and bring it back to, we're in a totally new Twilight Zone episode where, expect the unexpected. And I'm just saying, the way the market has been pricing assets in risky jurisdictions, make sure you look at your portfolio and look at the geopolitical risks. There's areas in Africa that historically were very, the biggest funding came from America. In the last 2 years, the biggest funding is coming from China. And the roads, the bridges, the infrastructure is all being built by Chinese. Like, I've been to areas in certain parts of Africa where you get a camp, you got 400 Chinese guys it's looked like a James Bond episode. They all wear the same overalls. They sleep on a 1-inch mat with 40 or 100 guys in one giant tent. There's no bed. There's no tents that you're used to seeing in these development projects of like Australia or Canada or the US. It was like, get out there and go. And these countries have really started being influenced by the Chinese infrastructure, the electrical grid, the power sources. So it really is shifting this the geopolitical alliances, and you have to pay attention to that in your portfolio.
Yeah, my mum does a bit of work in Tanzania, and she said recently that they defaulted on a $10 billion loan to China, and then China withdraw, and very quickly, their hospitals are running out of money and support, fresh water. Have you seen that sort of thing firsthand as well? Like, what does it look like once the China withdraw their support? And
well, you look at areas like China's put out their big Vision One Road, One Belt plan, and there's 3 major countries that they're really investing heavily in, and they're always on the ports. You look at what they're doing in Ethiopia; they're a major funder in Ethiopia, but yet Ethiopia is a really interesting one because historically, the war between Eritrea and Ethiopia, Ethiopia was always supported by the Americans, right? Now, the funding from China is eclipsing that of America, but there's incredible resource wealth in Ethiopia. I know people laugh and they go, what? Well, yeah, there's some major gold companies hitting huge intersections in Ethiopia. So that's one country that I'm following very closely for this swap line battle. Which way is Ethiopia going to go? Are they going to go positive swap or negative swap? But one thing I can guarantee you, Alex, before they decide which way they go, they're going to try to extract as much as they can from both sides. So that's kind of the new normal of, which assets are there. There's some major, the biggest mining companies in the world are extensively in Ethiopia, but so are the Chinese companies because of the wealth there. So that's going to be an interesting battleground. Morocco, when you talked about agriculture, people forget all the wealth that Morocco has in the ground. Again, huge investments coming from China. You look at areas in the Horn of Africa. Historically speaking, we're going back over 200 years ago. The Chinese have always had their alliances there, and now it's the last decade. They're really all the big transmission lines, the roads. Those are all Chinese companies and Chinese funding, not American. So there's some interesting areas, but Ethiopia is one that I think is going to be very interesting.
So we might dive into this more next time, Marin, but I guess the big question on everyone's lips is inflation or deflation. It sounds like you're leaning towards deflation in the short term. Yeah.
Yep. Especially in the emerging markets. And, we have a mutual friend. He calls it the milkshake theory. I tease him about it, but essentially you're seeing it now because the commodity prices, you look at Russia, you look at Saudi Arabia, you look at all the other OPEC countries. Their saviors, their production costs are in their local currency, and they're all going to have this cut to kill strategy, whether it's uranium or oil. We saw it with oil. That was Saudi going, okay, we're going to do the cut to kill strategy. And that is deflationary because there's less dollars chasing the same fixed number of goods. That's deflationary. So we're going to go, in my opinion, deflationary, then you go stagflation, then inflation. But right now it's deflationary.
Yeah. Well, guys, we'll put the links down below. Marin's got plenty of free research on his website. We've got a discount for all the subscribers, a bigger discount if you are a member. And a question we got was, can you claim this in your tax and your super funds and whatnot? And that should be fine. So thanks, Marin. We're going to do this every month, and leave any questions you've got below, and we'll catch up again soon.
Stay well.
Cheers, guys.